what that said, we are going to talk about, and this call is going to be in 4 phases, all right? So starting off, all right, the number one, or the starting phase, all right, we're going to start with 2 basic phases of this, and then we're going to go into phase 3 and phase 4 and phase 5 of this call. And phase 3, 4, 5 is going to be more about interconnections. It's going to be a little bit more complex. So of course I'm going to wait and see if anybody have any questions before I move on into those phases. But we're going to at least start with the basics, and we're going to just start off. So phase 1 is just going to be I'm just going to explain a little bit, so like an introduction more or less. So phase 1 is going to just be key macro news events. So it's just going to explain each and every sort of news event, why I use them, how I use them, and just talk about a little bit of things I've not already done, but also a little bit of new things for everybody. So you guys will really understand all of these news events to its core. Like you're going to be, after this call, be able to look at the graphs and understand them, and like a total sense, guys. All right. So we're going to cover, for example, PPI, CPI, non-farm payroll, FOMC, unemployment claims, retail sales, ISM, PMI, alright, manufacturing, and services. That's phase 1. That's more or less the section 1 of this call. Now then we're going to go into section 2. That's pretty much how these news events impact the markets. It's fairly as simple. So we're going to go into more or less the direct correlation, indirect correlations, long-term effects, short-term effects, more or less, of these things. But ultimately, we're going to look at this from a central bank perspective. So I'm going to give you guys some examples of how you use these news events, for example, because, of course, it might be hard for you guys in the beginning, like looking at these things, because, look, you need to understand them in an complacency. And I'm not teaching you all these news events just so you will understand the core of them, right? I'm teaching you all so you understand the core of them, so you can actually, you'll understand at the end of this call, so you can develop more or less, like I said, your own methodologies, but also understand forward-looking assets in the best way possible. Because for you to ultimately, in the future, determine the forward-looking assets yourself, because it's not going to always be the same, you need to understand the economy as its core. You need to understand these principles and how the central bankers is looking at the markets ultimately, and this is what they use. All right, they use these measurements, these macro measurements, because ultimately these news events is macro measurements. And so I'm going to show you the most important ones and the ones I use personally, and how I use them, etc., etc. But I'm also going to show you how the central banks see it and give you guys some real-time examples of this, so scenarios which has played out in the real world, which of course have led to alternative monetary policy. So when monetary policies shifted and how they looked at it, what they looked at, etc., etc. That's phase 2. That's only phase 2, guys. Phase 3, that's going to be more or less us looking at how these news events actually impacts the second underlying dynamic. So more or less how you can use these things to not only determine where the first underlying dynamic will go, meaning the real rates, like the real interest rates set by the more or less monetary policy. So of course, phase 2, like I said, section 2 of this call is going to be more or less how you determine where the rates will go ultimately, which will of course enable you to determine where the rest of the markets will go ultimately, from equities to FX, foreign currencies, right? But the section 3 will be how you determine it day to day, like what these impacts ultimately and how it correlates to the second underlying dynamic, etc., as well. So we're going to go more or less into first underlying dynamic in there, so like Fed's just monetary policy path. And I'm through all of this going to show you the things and the measurements I use, so I don't necessarily go in and look at this each and every day, but I'm going to look at different measurements, etc. And that brings us to section 4 of this call, where I'm pretty much going to show you all the economic indicators I use. All right, so all economic indicators, that being meaning yield curve spreads, and I'm going to go through yield curve spreads in detail. I've said I was going to do all of this so many times, so I'm going to just, I've pretty much planned this call for 7 days, put it all freaking together, the things I've said I was going to do. And so here you have it. It's probably going to be one of the best calls I've ever done. I'm going to go through, and of course, I'm going to go through all the indirect, direct correlations of these things. So all of these things. Then we're going to go through M2, money supply, that's one of the economics indicators I use. Of course, Fed balance sheet is one of them, real interest rates and global liquidity flows, that's another one, that's the last one. And then pretty much what this all leads towards is forward-looking assets. All right, how you establish forward-looking assets. So in this call, I'm also going to have and include a guide to how you develop your own forward-looking assets, because ultimately you might find a forward-looking asset, meaning an asset which predicts price, mirrors price in the future to a probabilistical sense, better than me. For me, and that's why I'm teaching you all the basics of how you determine forward-looking assets and how you develop forward-looking assets and find forward-looking assets, right? Because ultimately, in the future, it might be you developing these indicators. And what I mean with an indicator is like, let's say you more or less cannot find any forward-looking assets, so you develop a basket of different assets and put them together, more or less like your own indices, let's say, and that's indices you use to predict price. So this is what you might end up doing in the future, like home builders, for example, being a leading indicator. And I've included a guide in this call at section 5 of this call for you guys to be able to establish forward-looking assets. So let's dive right into this. All right, so let's dive right into this. But hopefully everybody is freaking excited. This call is recorded. It's going to be edited. It's going to be pretty much published, edited, etc, etc. Now, big disclaimer, the first 2 parts, since it's very basic stuff, is going to also be published to YouTube, but the section from 3 to 5 is not going to be published at all. And that's for the simple reason that, well, of course, I don't want to include how people establish forward-looking assets, etc, etc, and how they look at these things and determine these relationships, second-hand dynamic, for example. I don't want people to find out. But let's dive right into this, all right? Starting off with the product price index, is the PPI. I think everybody, of course, have heard it sometimes when you look at Forex Factory, for example, etc, etc. You see, oh, it's a PPI day. I'm not going to trade. But what is actually PPI? What is it showing, etc, etc? Well, PPI measures the average change in selling products received by domestic producers for their output. All right, that might be in like hard definition to understand, but in simplistic terms, it's pretty much the price change, meaning how much price increases or decreases from the production, like how much the production cost of making a product, right? And so this, as everybody, might have already read here, is just very freaking good. Actually, one of the best indicators or economic economic news events, because this can be used to predict, for example, CPI. So whenever, it's not you can actually predict CPI, for example, to an extent, right? And this is all logical, so I'm going to explain it through a logical sense. Now, remember, why is actually, when you're breaking it down, this is also what I want to teach you. I want to teach you how to break things down into simple steps. Since if you're breaking it down, you can actually see what it is composed of, and then you can find logical senses of where, the direction of things will go. So it's super simple. So breaking this down, well, what is actually this? Well, the definition, of course, states that is how much price increases of the product, like how much the production costs increase or decrease. It's super simple measurement. So now you understand logical sense. If production costs increase, well, the logical sense is that the product is gonna sell for a higher price. Let's say an iPhone is produced for $1,000. Super simple, guys. Well, now it costs 1,200, let's say, to produce instead. Well, the chances are that the product, since the margins goes down if they don't sell it for a higher price, so the chances are they're gonna sell it for a higher price, which means that the PPI could be used to forecast CPI, and CPI is the thing we're gonna go through next. But this is why you can use PPI, for example, to predict CPI, and this is why it's so good of an indicator. And like I said, in the basic terms, it's just how much production cost increase or decrease in percentage terms. So if it increases, the correlation to interest rates is higher interest rates. And what this is really good is that this is, as I said, a little bit of a forward asset. It's not an asset, right? But it's a forward-looking thing. So it's a forward-looking indicator to CPI. And CPI is what central bankers, majority of the time, bases their decision-making off. So remember this. Now break it down to simple terms, which I've taught you guys, hopefully. Hopefully everybody understands. Breaking it down to simple terms means that PPI should be in front of interest rates, all right? Because it's in front of CPI, and CPI is the main measurement tool of interest rates. Now, interestingly, CPI could also be in front of what? Interest rates. Well, but then that's just because the Fed does their decision after they get the data, not before. And you get the data at the same time, or nearly at the same time, the Fed gets the data. The data gets released at the same time the Fed gets it. Of course, this is to an extent, guys. Remember, this is to an extent. Now, here you can see this is more or less, Federal Reserve Bank of Louisiana. Super simple. This is one of the, indicators I use. I said I was going to cover indicators. Well, this is one of them. And it's just super simple. It's just overall consumer price index, or CPI, over production price index, which is, or producer price index, which is the PPI. And you can see how much of a forward indicator this is. So you can see the blue line right here. I just wanted to show you, this goes back to nearly the 1950s. So you can actually look at the correlation. You can look at how good this indicator freaking is. So consumer price index, of course, is the CPI simply. Producer price index is, of course, the thing I talked about. Is the PPI, is the how much production costs increase or decrease. So you can see when overall production costs increase, you can see right there. You can see the red right there increased, while the blue, which is the CPI, decreased. What does this mean? Well, it means that the blue should eventually follow the red, right? So the blue should follow the red because it has a higher probability, at least, of following the red. It does not always need to, but you can see when prices increase of a production cost, like if you produce something for a much more expensive price, chances are the people buy, or chances are when you're selling it, you're going to sell it for a higher price. It does not need to be. This is what I remember. This is like, This is what you need to remember. That all of this is just in percentage probability terms, right? So it's not what's needed to happen. It's what has a higher probability of happening, all right? Because the chances are, if you're producing something for a much more expensive price, you are going to sell it for a much more expensive price, since you don't want it to go down on margins, which is, of course, also something we're going to cover later, which is expansion, detraction in manufacturing, or PMI. This is something we're going to come up to later as well. So you can see chances are, if the red is increasing, the blue is soon to increase as well. All right, super simple. This indicator you'll find at the Fed, because this is exactly what the indicator Fed is using. And we are trying to look at the markets as Feds is looking at the market, since if we know what they're going to determine, we know the direction of the markets, since they're the one controlling the markets in real terms, if you think of monetary policy, etc., etc. So you can see right here, when the red is going down, chances are the blue is to follow. I'll just take some more examples here, but you can see multiple times when this, for example, peaked right here. We also saw CPI peak, and this goes, like I said, all the way back from 1950. You'll find this. You can just search CPI, PPI, leading indicator. All right, because PPI is a leading indicator for CPI, and since it's a leading indicator for CPI, once again, it's a leading indicator for Fed's decision to make interest rates hikes or cuts. All right, which is something which is very freaking good. Now, why is this good? Well, that helps us to determine the correlation to assets, etc., etc. So moving on, you'll find this, of course, in Forex Factory itself as well. I don't personally use Forex Factory that much to look at the graphs. You can see the graphs here looks a little bit more messy compared to from the Fed's charts themselves. So that's why I always, refer back to the Fed charts, which I showed you previously. I think they're a little bit cleaner, etc., etc. But they're released monthly as well, so I forgot to add that. But PPI is released monthly, guys. It's a monthly indicator, so you can use this. I think there is also potentially released quarterly, but I'm not too sure. But monthly, I know it's released. So once a month, this is out. Now let's go to CPI. So why is CPI? Well, CPI is the consumer price index, is more or less the change in price paid by consumers of a basket or for a basket of goods and services. Now, potentially that's, that you heard 1,000 times. You never understood really what that means. But in simple terms, that just means that you have a basket of different assets, and it's more or less change in prices, more or less. So if prices increase, CPI increases, prices decreases, CPI decreases. Simple as that. So it's the change in price in percentage terms. So it tracks inflation, because inflation realistically just simply means, do you use CPI or PCE? I use CPI. I use CPI. All right, but I use the PPI to determine where the CPI will go. All right, or you can do it. And since you can determine that, you can also determine how that impacts real rates, interest rates, set by the or Fed's just simple monetary policy. But we're gonna cover PC as well, so don't worry. We're gonna cover all of that is in this call, so don't worry. It's gonna be simple in the beginning, then it's gonna be harder. But I need you guys to understand all of this for you guys to understand how the economy really works, for you guys to establish and locate these forward-looking assets, which is, you know, my ultimate objective with this call. So the consumer price index is of course measurements. It's just simply measuring how much prices is increasing or decreasing. Increasing prices just simply means inflation. Decreasing prices means deflation. Super simple. If prices is increasing, chances are there's more money in circulation, as everybody knows. Thanks to, for example, Fed's printing too much money, or Fed just being lacking behind of the curve, more or less. That's what you usually call it when the monetary policy is too loose or too hiked, which potentially it is right now. Which means, you know, they're either in front of the curve or behind the curve. When I talk about the curve, I mean in business cycles here, guys. So understand this. Or inflation cycles, more or less, as well, because everything, that's why you have business cycles, and that's why to an extent the market is cyclical, and that's just because you have cyclical inflation, human behavior impacts all of this, etc., etc. It's just cyclical, and that's why the markets to an extent is also cyclical. What I'm saying to an extent is because you cannot determine that relationship to 100% effectiveness, but there is cycles in the markets, definitely. So overall CPI, you know, you don't want a too high CPI. It's something we have talked about so many times, right? And if the CPI is, you know, too high, prices, or money loses its purchasing power, which just means that the amount of money you have diminishes, right? In simple terms, that's literally what it does, because you can purchase less for the money you have, meaning it's worth more. The fiat money you hold is worth less. The more inflation you have and the higher deflation you have, it's worth more. But then, yet again, if you have diminishing circulation of money, that means you have diminishing investment of money, which of course potentially means that you have a diminishing economy. Since of course lower investments, lower money in circulation, more or less, in things you buy, etc., etc., because, you know, buying stuff like buying candy, etc., etc., is literally an investment in the candy company. If you're consuming more, you're investing more. It's literally how it works. Super simple, guys. So super simple to think of it. All right, so if you're ultimately seeing too low of a CPI, you have too low of an automatic either consumption or investments. It just means simply the same thing in this case, which just means that there's higher probability of seeing growth in the country, meaning there's higher probability of seeing GDP growth. So you need it to be stable. This is what the Fed thinks. This is what I want you guys to think of as well, since you should think of yourself as a central banker taking the decision. All right, since if you think of yourself as a central banker, think of yourself as the determining factor, chances are you're going to be having a much easier time predicting the markets. All right, super simple thought, super simple ideas. You know, realistically, you need to be as smart as the central bankers to determine where the markets will go. And I want you guys to be as smart as central bankers. So that's why I'm going to go through all of these things. So you can read about here. So of course, if CPI increases, the chances are, you know, the Fed's decision making to raise interest rates increase the dollars. So listen, this is something I need you to understand, and I think this is what I think everybody now understands. Since CPI is literally inflation, it would make no sense for the dollar to rise when it's decreasing in its purchasing power. Well, reality is it actually increases in price, but it's not due to the CPI. This is what I would need you guys to understand. It's due to the monetary policy which comes after the CPI. All right, now everybody starts to understand. So it's not realistically the news, is what the news means. That's what determines what price will go. And this is when you start understanding that CPI could mean both up or down dollar, determines or pretty much what's it called? So I'm just going to cover this later, by the way, so I'm not going to be going on any sidetracks here. So you'll see plenty of times that potentially you see a rise in CPI, and a rise in CPI could potentially cause the dollar to go down, even though bullish CPI in theory should lead to a bullish dollar. And that's just because it's what the news means in real terms. So potentially, let's say you have a CPI of 20%, and that should give a bullish indication for a currency. But let's say the Fed is super behind the curve or super in front of the curve. Well, that potentially means bearish because they don't have any real. They've just lost control over it. So that's why you gotta understand, like, it's the thing behind the news which determines like what the news does or how the market moves. So let's move on. So you can see right here what I want you guys to do, like again, and with everything in the markets, be it the future, etc., etc. You need to break it down to the core things. You need to understand it. You need to understand it to its core. All right. When you learn something, you need to understand it to its core. Otherwise, you won't be able to discover why it freaking works. Otherwise, you'll just let it be. And I don't like it letting be. All right. I'm like that autistic, so I need to understand like why it works, all right, and in terms of like to the most specific things. And so yeah, I need you guys to continue and just continue breaking it down until you add its core, all right, physics principles here. So as you all know, this is just a breakdown of what the CPI actually is. So CPI is actually comprised of core services, core goods, food, energy, and this is literally what it's comprised of. So let's say you have a specific tariff coming out of a specific sector, and you see that sector is very, comprised, very little of the CPI at that given time. So for example, as you all know, CPI is the change in price of goods, right? Literally what all it is. And so if you know, all right, for example, let's say a lot of people are saying, well, we're going to see a hike in CPI. But then you see CPI going lower. Well, potentially that tariff, and this is just an example, this is no real-time example, but this is just for example, so everybody starts understanding this. So if you had not broken it down, you would think that tariff potentially would lead to a rise in CPI. But let's say that tariff was, for example, on just food. All right, and you can see food just comprises so very little at that given time of the change in prices, which just means that you're potentially looking at, since the other, let's say, core services and core goods have gone down, you're more or less looking at a lower CPI, even though you have these tariffs, which a lot of people are thinking is going to rise the CPI. But since you understand, and since you have broken it down to the core, you really understand what the outcome is going to be, which enables you to determine where price ultimately will go. It will help you when you understand all the core concepts, all the core, and have broken it down into steps. Everybody understands so far. By the way, guys, I'm super sorry for mixing words, but everybody understands so far. This is why it's so freaking important. Just want to hear yes or no's, or if I need to explain more, or if I need to give another example. It's perfect, guys. Perfect. Yes, guys, this is perfect. I need you guys to follow, right? It's going to be a little bit more complicated. So this is, of course, something I use right here. Here you have another indicator I use, another measurement. So I don't use the one from Forex Factory. Instead, I use this one from BLS, or the Bureau of Labor Statistics. It's the one pretty much creating all of the data for the Fed. All right, so I go straight to them and I see what what core of CPI has gone down. So like what the CPI comprises of. No worries was. So you have to understand like the things, if prices in an individual, since core CPI or CPI is comprised of these individual things, you need to understand if these individual things have gone up in price or down in price. You need to understand the compression of the CPI. You need to understand like what's built up of. For you guys to understand and determine if it's going to go up or down. So you can see energy, for example, here, and this is a real-time example, has actually gone down lower, while food and all other items have gone up in price. Well, the energy can potentially offset because it's a little bit deflation, right? It has gone actually down in price and potentially will offset a little bit of the foods, etc., etc. Now, this is a very good real-time example because you always hear, for example, oil, and now you can understand all of this because look, we know that if we start, for example, seeing now energy, right, for example, go up in price, and how do we measure energy? Well, potentially oil prices, guys, etc., etc. Uh, since we know that energy is literally the thing that has held up the economy, held up indices, and since we know, GDP, etc., etc., follows or is correlated to indices, we know that if GDP collapses, which it potentially could if energy prices goes up, since then we have a rise in CPI because all other prices goes up, and it's not offset anymore by lower oil prices, the whole market is going to collapse. So this is why you need to break things down, all right? Since now you understand that energy is something you potentially could have extra coal of. Like you can look at energy at an extra like an extra time, right? Since it's extra important here, since it's the thing which more or less in this case could be a forward-looking asset to determining when indices is gonna go down. At the moment, it will shift in the future because potentially food, etc., etc., is gonna go down in price in the future. It's gonna lead to lower CPI, lower rates, etc., etc. But this is the thing. This is how you determine. I just did it right now. I just did it for you guys in front of you. And so, do you guys still follow me? I just want yes or no's. Or do you want me to explain even further here? But this is like the core ideas of what I want to share in this call. Like realistically, break things down and understand them. And that's why I'm covering these specific indicators. Like what I mean with indicators is macro news. Is because if you break them down, you'll understand forward-looking assets. But you'll also understand like where interest rates will go, etc., etc. So it has indirect and direct consequences. What I mean. Let's just move over. So let's just move over to non-farm payroll. This is just super basic stuff, guys. Super basic, like I said. So now we're going back a little bit, but I just need to go a little bit deeper in when we talk about CPI, because CPI is ultimately one of the most important things to determine future forward-looking assets, etc., etc., in determine Fed's policy. But you have non-farm freaking payroll, all right? And so why is non-farm payroll? Well, non-farm payroll is simply the amount of employment in the whole market except for the farm employment. So it's everything, it's all the employment except for the farm employment, and except for non-profit organizations, etc., etc. I think that's it, literally. And some special government jobs is also excluded from this. And since y'all know, if, for example, non-farm payroll, goes higher, right? We have more people employed, or we have, more jobs created, right? Which just simply means that the economy is looking good, right? The more people employed, the higher probability of seeing a rise in interest rates as well. Since the more people is going to have wages, and if the wages increases or decreases, the more money they will be able to spend, all right? And if they were able to spend more, they potentially is able to increase the curve of CPI, like inflation, etc., etc., because they spend more, right? The consumer spending is also an indicator you can use, but I think I'm not gonna cover it in this call. But it's not really that important. That's why I'm only covering the most important things. So the only thing you need is that this, of course, has an inverse relation to interest rates. If this is high, that the probabilities of seeing an high interest rates is increased, while if this is low, or if it's going lower, the probability of seeing cuts in interest rates is higher. That's just all you need to understand at the moment. Nothing else, nothing more, alright? Now, you'll be able to see, usually we see average hourly earnings and non-farm payroll. Non-farm payroll, by the way, super simple basic stuff here, is released. This is a very special exception, and this was just because it's released the first Friday of each month, alright? You might have heard that. So of each month, the first Friday, except for 4th of July's Fridays, etc., etc. This is why we'll release on the Thursday this time. This was the latest report. And I'm just want to, of course, take a real-time example here as well, since I like real-time examples and I want to stay up to date with the markets, etc., etc. And I want you guys to stay up to date with the market, so I'm just going to cover it. So this was the latest report, as y'all might have heard, right? And we have already talked about that. The non-farm employment change, it went upwards, right? Meaning more people got employed, right? which just simply means that there's more jobs created, there's more people employed, which just simply means that, in terms of looking at the Fed's decision making, do they necessarily need to cut rates if the economy is hot? No, because if the economy is hot, that increases the probability of people being able to spend more in a low interest rate environment, which will ultimately lead to what? CPI go high, alright? Which they don't want. They want the CPI to stay at 2%. So that's why I think they're not going to cut rates. There's just another reason for it. Hopefully everybody starts understanding this. Now, of course, you'll also have unemployment rate. And unemployment rate right here is also an important metric. We'll just discuss it a little bit. It's very self-explanatory since it's in the name. It's just unemployment rate in the country. And so unemployment rate is low as well here, which just means a strong economy in simple terms. And I'm gonna cover unemployment claims. I think it's the next one. Yes, so we have unemployment claims and monetary policy. So unemployment claims, the only thing you need to pretty much realistically know about it is same thing as JOLTS Open, all right? And what's extra important in this is that unemployment claims is usually very explosive. So I'm gonna show you some real-time examples as well from unemployment claims. But when the unemployment starts to rise, it usually rises for consecutive months. And this is one of the, like, if you see unemployment one time, like, go crazy over expectations. So let's say you have an unemployment forecast of 4%. Like, they're expecting a country, and this goes for all countries, to have an unemployment rate at 4%. But then it, gets released and it says 6 or 7%. Meaning it's above the forecast, which is of course very bearish for the currency because it means lower interest rates. Now, why does it mean lower interest rate? Because it means lot less people are employed. Now, what is the Fed's ultimate goals? Well, it's to keep employment high and to keep the inflation at 2% and keep a steady growth. All right, that's literally what the Fed's and what all central banks' job is. Majority of all central banks' jobs is. With some exceptions, etc., etc. So if this spikes, you usually see massive spikes following after it, which just simply means that the economy is in turmoil. It means recession, guys. So if you see unemployment rates goes high, that means lower currencies, which ultimately leads to lower interest rates, hence why lower currency, and ultimately leads to panic, I would say, because this is more or less the last thing that ends up happening in a recession. It's companies laying off their workers. So the last thing to happen is always unemployment. So it's already going to be in the already going to be in the PPI, PMI, etc., for us to be a recession, and especially in the yield curve, and the yield spread, which I'm going to talk about later. So you'll already know this happening. You'll already know your country being in a recession or a country being in a recession before it happens, since I'm going to teach you to be that good. So don't worry, guys. But this is just one of the things, it's really important, but it's not necessary to know since we don't use it, since we're too good for it. All right. So as you can see, unemployment, when it starts rising, it usually continues rising. And as during the periods, you can see 2008, we saw unemployment starting to rise. Now, this was before everybody, and I'm going to show you how to predict recessions, etc., so long before they happen. And so you can see 2008, we saw, the 2008 financial crisis, and you saw more or less unemployment start to rise, and you can see it continue to rise. Similar in 2002, 2001, you can see it started rising and just continued to rise. And then in 2020, of course, with the COVID-19, you saw it rising, and then you saw it sharply falling, which it usually do. So it does like these spikes. And so when it's rising, the Fed is in a panic overall because it needs to keep employment high and unemployment low. What this simply means, as I said, is just that the Fed is going to cut like crazy. All right. So if you see employment go like crazy, the Fed is going to cut like crazy. Exactly, bro. Exactly. That's correct. That's correct, bro. So I'm gonna cover all the correlations to the direct markets after this as well. So you don't have to worry. That's the stage 2. So we're only at the stage 1. Me just explaining these simple macro news. All right.
Yes.
And
Oh,
after that, I'm gonna pretty much explain the correlation to the markets. First analytic dynamic, second analytic dynamic, and markets. And then after I've explained that, we go to stage 3, stage 4, and stage 5 ultimately. So let's just continue. So then we have retail sales. It's just super simple. All right, it's super simple. This is, you know, pretty much a growth metric. Super simple. If it goes higher, we have higher growth. If it goes lower, we have lower growth. You know, if it goes higher, we have expected a higher GDP. If it goes lower, we're expecting a lower GDP. Simple as that. Now we go to PMI. Super simple here as well. PMI is simply a survey. So, you know, this is to an extent correct, but it does not always need to be. Why? Because at the end of the day, it's a survey, all right? So this I listen less to, but PMI is just pretty much goes in and asks or statistics for labor control or whatever. Literally go and ask business owners for them to and ask if their business is expanding or contracting. And so if it's over 50, it's expanding, meaning you're having a hot economy. If it's not expanding, you're not having a hot economy, and you're having a cool economy, cool down economy, which means, you know, velocity of money is going lower, while expanding just means velocity of money is going higher. This is also a little bit of a delayed indicator. It's not very useful. I don't use it that much, but you can use it, of course, since remember, if you're building a case study of fundamentals of macroeconomics or of macro news, all right, more or less, you'll always build a case study. And so for you to prove, for example, for the Fed. So let's take a real-time example here as well, so everybody like understands why I'm explaining these stuff. So you need to build like these case studies. So now I'm building a case study for the Fed to not cut rates. Now I need confirmations because I cannot just guess the Fed will not cut rates. I need, you know, confirmation for the Feds to not cut rates. And so if I have the majority of these new macro news indicators leaning towards a hot economy, meaning an expanding economy, I have a better, you know, and higher probability of being right in the Fed's decision-making abilities. So, of course, you know, it's super simple. So as this is a little bit delayed indicator, it's not a forward-looking asset. It's not like any of this, all right? It's not an asset, of course, but it's not a leading indicator. It's a lagging indicator, but you can still use this. It's still very useful to build cases. So if you, for example, have an CPI going higher, let's say, which we have now, if you have, for example, then PPI, we have seen PPI going higher and CPI going higher, PPI being a leading indicator, which means that next time potentially CPI is going to just continue increasing since, you know, the production is costing more due to tariffs, and then we have, let's say, potentially we're looking at oil prices rising now, which is potentially going to collapse the whole economy. We don't know. And then we see, for example, job unemployment claims. You know, we have the unemployment claims going lower, which just means that the more people is employed, which we also saw in the non-farm employment change. We saw the employment going higher than expected, than forecasted. Plus now, let's say we see the final straw, more or less, PMI surveys release at 51, which means that they're slowly expanding. The businesses is slowly expanding and not contracting, which just means that why should the Fed cut rates? It would make no sense for the Fed to cut rates. All right, this is what you can clearly say, because all the indicators is leaning towards Feds not cutting rates. So the probabilities is increasing, which I'm going to show you later. Since you have this near 0.9, I think, ratio of correlation between, and this is like a correlation coefficient, 0.9 correlation coefficient between these metrics and the Fed's decision making. So the Fed nearly always listens to these decision macro news events. So like I said, it's not because the news events react to markets or moves the markets. It's because what the news events means, that's what moves the markets. So then we go to simple GDP. This is the lagging indicator of them all. It's pretty much the one which determines if you're in recession or not. If GDP goes lower, your country is detracting, it's not expanding, you don't have economic growth. If it's increasing, you have economic growth. This is super lagging, but at the end of the day, you can, you need to know GDP. So that's why I included it. It's just something you guys need to know, even though it's not very useful for us as short-term traders, or just for us to establish any indicator. So it's a very lagging indicator. So it's not a leading indicator, it's a lagging indicator. So you can see I also included the leading indicator forecast where economy might be heading. So like it might be heading. Then you have coincident indicators, offers updates on economy's current state, and lagging indicator reflects the economy's historical performance, GDPs, and lagging indicator. So these are the things I want you guys to take with you. You have these sort of things, you have these 3 things, all right? And these 3 things is the things you need to understand you have. So you need to find leading indicators, but then you have to find them through these these middle indicators and the lagging indicators. All right, that's why you need to break them down. Now let's go through pretty much the real shit. All right, so now we're approaching stage 2. So we have only been at stage 1. We're approaching stage 2. Now we're going to let it go a little bit more complicated. So like I said, we're not following these news events. A lot of people are saying, oh, this is the real fundamentals you're talking about. No, it's really not, because it's what the news means in terms of the Fed's decision making, which ultimately I believe, since this is my methodology, this is how I believe. Anybody else can have different theories, different, whatever they're thinking. But I think at least the news is not the thing that moves the markets. It's the central banks which moves the markets, as I've always said. It's not them themselves, but it's their decision making which moves the markets. Ultimately, where they want markets to go, etc., etc. And so you can more or less, this is just what I wanted to talk about. So you have to think yourself as a central banker, and you have to think yourself where is most reasonable for the markets to go in determining these things. And so the market can do unexpected things. And so if it does unexpected things, you're not with what the central bankers is thinking, because ultimately the market is always the one being correct. Since ultimately they're the one best and most probabilistic right in terms of Fed's decision making. But in some cases they're wrong, and they can take opportunities, like I showed you with everybody being wrong about the bearish dollar on the Thursday, with everybody thinking Jerome Powell was going to get fired. I knew it's not, so it was a real inefficiency, and I exploited that, and I did the opposite of what all retailers did, and I pretty much took them all out. That's simply how I do it, since in some cases the market is not random. Alright, but in majority of cases it is to some extent random, which is why I need to have statistical proof it's not at those simple cases. So all of this goes together, guys. All of this freaking goes together. You need to think of yourself as a central banker. You need to think of yourself what really moves the markets, etc., etc. Now, what I would recommend you, since what I want you guys to remember is that not all of these indicators or macro news events is equally as important, since the Fed will pay different amount of attention to it depending on the periods you are at. Remember I said the market is ever evolving? Well, the Fed is also ever evolving. And you might even have new leading indicators and new things popping up, which you need to discover yourself. No one is going to be like me and tell you guys what the leading indicator is. You guys need to figure it out yourself. And so now we're going to stage 2. This is a thing I do each and every month. I read the freaking Fed's stability report, because in it leaves clues of what the central bankers is focusing on as macro news, etc. So which macro news they're focusing on even more. All right, and as you all know, I've talked about unemployment and CPI. Those are the things he's focusing on now. Where did I find it? Right here in the financial stability report. So I'm gonna drop notes after this call, of course, for everybody here. So don't worry about it. But this is like what I'm trying to hammer into your heads. All right, read this shit, because this can literally. Yes, I'll drop the link, but you can literally search just right now, guys. Right now, I want everybody right now quickly to search Fed Financial Stability Report. Do it right now. I'll give you guys like 30 or let's say 20 seconds to do it, and then you'll find it, because it's simply taken from the official United States government website. You can see right here an official website of the United States government. So it's the first link, the Federal Reserve. Go into their website and you'll find it right here. This is, of course, what the Board of Governors deems to be most important. It's the 12 decision-making heads of the Federal Reserve, which looks at this, and this goes for all countries. So potentially you want to invest in a stock in your country or an index in your country of origin, etc., etc. Want to be more diversified? Well, do the same thing. Like, look at the risks, look at the things, and deem it like potentially, the dips, of course, will occur. By the way, a little bit of sauce here. Going back to unemployment claims, right? So unemployment claims, when the unemployment is maximum, that's when in a 0.9% correlation coefficient, the indices will hit their bottom. All right, literally. So when unemployment hits max, indices hits the bottom. Super simple, super simple. So that's some sauce. So for those indice traders out there, or just investors, portfolio managers, whatever, when unemployment is max, indices is bottom. Okay, let's move on. So here you can see just an example. This is in one of them. This is in the 2021, January 31st. This is pretty much their decision making, and what they want to do is pretty much bring down the, you can read right here. So, accept plans for reducing the size of the Federal Reserve balance sheet May 2022. So this is what they wrote May 2022. What happened after May 2022? Like, listen, this report was out long before we saw any of the rate hikes. They wanted to they wanted to cut the Fed's balance sheet. Now, the correlation between Fed balance sheet and interest rates. I've taught you guys it. And so you had already these clues out there before it even happened, before they even rose these interest rates. They wanted to cut the Fed balance sheet May 2022. Look at this shit. And so look, now we're going to go into real-time examples, and after that we're going to go into, this is the officially stage 2. All right. And then we're going to go into stage 3. So let's take this real-time example, guys. Hopefully, like, everybody enjoys this so far, by the way. Yes, that's perfect, guys. And everybody understands so far. If you have any questions, of course, leave it. Not leave it. Like, let me know. That's what I mean. So don't leave it. But I mean, like, put it in the chat. That's what I mean. So you're gonna go through some real-time examples here. So, real-world example number 1. So the Fed's pivot in late 2022, early 2023. So we had macro cluster, all right, and this is what I call when majority of the things the Feds is looking at is leaning in one direction. All right, it's super important. So we had, of course, CPI in October 2022 came in lower than expected at 7.7 year over year versus 8 forecasted. All right, suggesting a potential peak, because CPI is also, as I said, cyclical. So if it starts going down lower, it usually continues down lower. And so now we're in the decline period of the CPI, like real-time talk. We're in the decline period of CPI. We have been in the decline period of CPI since 2022. And this was, of course, when they started raising high. So look, this overall suggests a peak in inflation. This is what you have to think. This is what you have to think, guys. Like always, when you have these data coming out, you have to think like the real central bankers. You have to think, oh, it suggests a peak in inflation might have passed. Now, PPI and core PCE, let's go cover both of them. So both started decreasing around Q4 2022, supporting the narrative of easing inflation pressures. Super simple, really important. PPI, as I said, is the leading indicator for CPI. Super important. Now, NFP and unemployment, job growth remains strong, but the wage inflation started softening slightly. Wage inflation is simply the amount wages is increasing. Since it's going down lower, people have less to spend. You have to remember all of this, which means potentially lower CPI in the future, which become this domino effect where you have the lower CPI, lower wage, lower CPI, lower wage, lower CPI, lower wage until it stagnates, and then it starts over, with the business cycle. Then we have ICM manufacturing PMI slipped below 50, contraction. So you have to build this case. Retail sales started flattening out after months of strong consumption, hinting towards possible demand destruction. Yeah, I think it's called destruction. Now, what happened? So, overall, what the Fed did in December 2022, so listen, after all of these things have dropped, because remember, the Fed cannot make a decision without the data. All right, you literally know the times the Feds will make the decision, because they can only make the decision and period and a set number of periods per time per year. Oh, I'm sorry. Maybe you didn't understand it, but they can only do it like certain periods of the year, and you have it at forex factory. Like, so literally, like, you can predict it before it's even gonna happen, and the chances are the market is not pricing it in, and if it's not priced in, it's an inefficiency you can exploit. This is what we're doing. This is what we're doing as traders. This is what I want you guys to understand. And if you have understood these things to a core principle, you'll understand how to create these forward-looking assets, which ultimately I'll show how to do at the end of this call, which will lead you guys to potentially be forward thinking from the markets, having these leading indicators decide what you do. Since if you have these leading indicators, chances are you're going to be before the markets, and if you're before the markets, you can make some freaking good money, since this is what we're doing with, for example, yields, etc., etc. Now, the Fed slowed its pace of rate hikes from 50 basis points to 50 basis points from 75 basis points in prior meetings. So they still hiked it, which is potentially something they should not have done. Like, potentially this could be catastrophic if you understood the data, which could potentially means you making decisions, pricing it into the markets before everybody else pricing it into markets, making you a good chunk of money. Because look, if the overall continued hiking here while the data suggested a contraction, because you had lower CPI, you had lower things, you had all the data pointing on lower, and it still hiked, that means something is skewed, right? That means there's some sort of inefficiency you can exploit, etc., etc., in fundamental inefficiencies, etc., etc., in the markets. Which means, you can price things into them before, because if, they continue hiking, you need to understand, like, what happens if the Fed doesn't understand the data? Well, if they continue hiking while the data suggested a contraction, that could be major recessionary. That could be like crazy. And potentially they did that to be smart, because you saw inflation being 7.7. So you have to think of them as them. You have to be them, more or less. You have to understand why potentially they did this and the different reasons for it potentially. So they were at 7.7. So maybe they were just hiking rates because they wanted the CPI to fast fall to 2%. Like, they wanted to be extra aggressive. So look, that all of these reasons could be. But now like, even if, because you saw the macro news drop before, so you can already, in those macro news, and position yourselves, for example, for an loosening dollar eventually, because of course this led to, as you can see, the market you can read right here, just quantitative tightening of course continued, but rate path expectations dropped. So for example, potentially the dot plot started going down lower, which led to the yields, all right, peaked and began to fall. Pricing and easing, already happening. Yields is always forward-looking asset. This is why we're using it. It's the brilliant market, more or less. It's the market which is reacting most to these Fed's decisions, etc., etc. It's the ones which is the smartest, I would say, like the yields, the collective yield, collective bond, and the bonds demand supplies the smarter, I would say. So that's why we're using it as a leading indicator. And for example, as you saw, the yield started like already in December. What is the month after December? Well, September. And so you can see September the dollar peaked. So the yields already fell prior to the dollar. But the news events, the macro news events, which you potentially could understand prior, which affects the first analytic dynamic, was before even yields started dropping. So just understanding that could lead you to be like massively even better than the best macro news traders out there. Macro, and like, for real, guys, this is the real shit. This is the real world, guys. You can see Nasdaq and equities risk assets rallied, pricing in less aggressive Fed. So potentially here, there was less aggressive, but potentially, the Fed could make it a wrong decision here. So, the rally here could be interpreted as a sell opportunity for indices, because, it's just a rally into a sell manipulation, guys. This is why you have to focus on the structure of things as well. Key insight, this shows a combination of softening inflation, slowing PMIs, stable labor markets led to Fed to signal a shift, right? Not based on one data point, but a cluster of covering evidence. All right, this is exactly the type of first underlying dynamic shift your model aims to anticipate before full market repricing. Look, this is it, the CPI laying on top of the dollar, and so you can see the CPI is also a leading indicator towards dollar movement. And since we have a leading indicator towards CPI, we can predict the CPI before it happens, and the CPI can predict price movements. And it's so good, guys. Like, this goes so deep, so it's so good. So you have to understand, like, you have to have so many things in your head, and the more things you have and the more things you know in and out, the better. You can see how good of a leading indicator it is. You can see June right here. We rose later. We dumped later. This is such a good leading indicator. Rose, stayed neutral at the 2%, right? Dumped. Here we saw, I don't know what happened here, but I don't know, some more maybe or something like that. I don't know. But then we saw recession. You see, dumped, then afterwards dumped. Rose, yields rose, dollar rose afterwards. Peaked, dumped, and then dumped even more. Crazy good, right? Here we have the federal funds rate as well. So you can see, definitely was, it was here 2015, 2016 was the increase in interest rates, which rose the dollar. So yeah, I don't know why they hiked interest rates when the inflation was so low 2016. So yeah, I don't know. I don't have a real good answer for this. I don't really remember. I was not really that good now that back then, but you can see right here. So CPI leading indicator for interest rates, and interest rates leading indicator for rest of the markets.